Good afternoon. Present time is 12:07 p.m. and today is Monday, the 7th of July, 2014. Alpha Trading Strategies. We're looking here at crude oil. Present price, as you see here on the live market, is 103.44. This is the August contract. If we do take any positions, it will be in the September contract. Okay. A couple of things. Let's go ahead and take a review of the sequence from 3-4 until today. And let's go ahead and do that because we haven't in a while. Okay, so here we are from the 3-4. If you look at some of the previous videos, you will see that that is the date. The other one starts from the 13th of January. So looking at a total of about 6 months, and you will see here that the total percent profitable, all trades overall, and it's pretty respectful 74.81%. Long trades 81, short trades 67. Okay. The number of trades per day. This is very important, guys, because we do not scalp. Number of trades. If you're making 4, 5, 6 trades, many of them make even more than that. 20 trades or more a day. We're looking at only one trade. Average time in the market, once again, because we're not in it for minutes or seconds, things of that sort. As you see here, overall, 6.6 days. Okay. Now, here is where we are going to diverge and go on a different path. Before we do that, how are we able to achieve that sort of consistency? Let's look at the graph, and you'll see cumulative profit from 3-4. You will see that it has been a steady increase. Okay. And if you go back, if you look at the total number of trades, it's not as if we're not taking trades. We are 131 trades. Okay, so going back again, that is the cumulative profit, and as you see here, it has been a pretty steady, and here we are at a 42% return over a 3-month period. Now, the average trader out there, guys, does not know how to read a chart. They do not. They use lagging indicators. They scalp. They're in and out, in and out, in and out. They're very, very fickle. And they trade with fear. They trade in markets that primarily are direction based, meaning that they're either trading stocks or they're trading futures. Both are what's called directional plays, meaning that you only make money when price goes in that direction. So here is the thing. How can we take something that has a very high statistical probability of accuracy and marry that to something to even increase our success ratio? Well, we figured that out, and that's why we call it isometry. Because essentially, remember, 80%, how is it that 80%, what's amazing is that 80% of all traders, I mean all, irrespective of who you are, who you think you are, where you come from, silver spoon, gold spoon, no spoon, fat, poor, skinny, rich, entrepreneur, engineer, business owners, retiree, how is astronaut, physicist, how is it that across the board, all of these people who are extremely intelligent people, how is it that when they come into this environment, they're all, for the majority, losers? Well, it's pretty simple. Number one is that they don't know how to read a chart. And essentially, what we have done is we've created a 12-point classification of all of the bar types found on a chart. And we have given them a meaning in terms of the professional mindset. So the three components are price, which means that at certain prices they're going to find price desirable to either buy or sell, they being professional money. Let's be clear, public, you and I, we don't count. All we're focused on is the mindset of professional money. Okay, so one is price. Okay. The next is spread, and that is a subcomponent of three items: the high, the low, and the close. So if we were to look at this bar here, it would be the high, the low, and the close. This bar here, the high, the low, and the close. Or let's say this bar here, the high, the low, and the close. And the third is volume, the volume that is associated with each bar on the chart. Now, by triangulating is the word, triangulating these three pieces of information, we have now created something that gives us predictive value. Listen, if you were standing next to a person reading a menu and the guy goes, "Wow, that's incredible," and you go, "What's incredible?" You tell the maitre d' that you'll have the steak tartare, and the guy next to you goes, "That's amazing," and you go, "What's amazing?" He says, "That you can read that," and your eyebrow raises so high, and you look at this guy and you go, or gal, and you go, "Read what?" He goes, "Read that. I mean, you're able to read that? How did you do it?" And you would want to say, "You fucking retard, it's a menu. What are you talking about? Everybody knows how to read a menu." The guy can't read, but you held your tongue, and he says, "Well, how can I learn to do that?" And you go, "Well, you have to learn how to read." And he goes, "Read?" He goes, "Yes." And so he says, "Where do you start?" He says, "Well, you're going to have to start to learn the alphabet. And then from there, you learn your vowels, your consonants, and so on and so forth. And that's how you learn to read." This is nothing more than reading. The first thing you have to learn, in our opinion, now again, there are several boats to China, so this is just our way. Because again, there are no indicators here. The only reason that people use indicators is because the information that's sitting right in front of you eludes you. That's the only reason why. Okay? Now, once you have that, the question is, what can we do with it? Well, we can now take that information and we can give ourselves even more advantages, because when we get a signal, it is a reversal. At that point, we can sell the option that, let's give you an example here. Okay, we're going to divide this into several videos because we want to take our time and really explain this. Okay, so we're looking at a chart here, and what are the advantages of trading the options over the futures or the stocks? Most traders day trade the ES. That's their play. Okay. So what Isometry does is it takes the alpha matrix, PVSA, understanding the 12 bar types as well as the sequence of professional money. Okay. So once you understand the pattern of volume and what must occur in order for professional money to get in based off of their weaknesses and concerns. Professional money has a concern that they have to contend with every day, and that is, how do they get into the market, as well as how do they get into the market without moving price away from their entry. They don't want to be the ones moving the market. And then, of course, the second is stealth. They don't want to broadcast their entry so that everyone can see it. So they've essentially solved the second one by algorithmic trading and breaking up order packets and things of that sort, so that now their orders, there are no big orders anymore. They've advanced that. But still, the overall capacity of their orders coming in is still very important. So we're going to stop this for a moment, and we're going to now go into part two.